Welcome to the deep dive. If you're running a business, or maybe just, dreaming of starting one, the numbers side of things can feel, well, like navigating a maze sometimes.
Absolutely.
Today, we're aiming to cut right through that complexity. Our mission, really, is to take this stack of detailed financial and tax rules and turn it into clear, actionable insights for your business.
Exactly. We've really dug into some comprehensive sources covering business income, expenses, managing assets, and even employer responsibilities.
Right.
And we're here to pull out those critical aha moments, showing you not just what the rules are, but also why they matter to your bottom line, how strategic thinking can make a real difference.
So if you've ever found yourself scratching your head over, say, the difference between passive income and passive activity income, they sound the same, right?
hmm
Or maybe wondered how a business can actually claim a full deduction for a major asset in the same year they buy it, well, you're definitely in the right place. We're going to help you get incredibly well-informed and quickly so you can make smarter financial moves. Sound good?
Let's do it.
Okay, so let's unpack this, starting with income. Most money a business earns is, well, no surprise, taxable.
Right. That's the default.
But our sources point out some really fascinating exceptions, places where income can be deferred, pushed later, or sometimes even entirely tax exempt. It's not just how much you make, but like how that money is structured.
That's exactly right. Think of it as strategic income management. One really clear example, and this applies to businesses just like it does for individuals, is interest you earn from tax-exempt municipal bonds.
Oh, muni bonds.
Yeah. A corporation, a partnership, they can invest in these, and that interest income just bypasses federal income tax. Pretty straightforward. A way to earn without adding to the tax burden.
Okay. And then there are those situations where you don't avoid the tax entirely, but you get to push it off to a later date. That sounds like a huge plus for cash flow.
Absolutely. It could be massive. A prime example is what's often called a like-kind exchange. You'll hear the term Section 1031 exchange.
Right, 1031. Heard of that.
Yeah. It's a really powerful tool. It lets you defer the capital gains tax when you swap one business or investment real estate property for another similar one.
Okay, so specifically real estate now.
Specifically, real estate for 1031, yes.
Yeah.
Instead of paying tax right away when you sell, you basically roll that gain into the new property. Keep the capital working.
Okay, that makes sense. What about getting paid in advance for services? Let's say Alex, who runs a graphic design agency, gets a big chunk of cash up front for a year-long project. That feels like it should be taxed right away.
Generally, yes, you're right.
Oh.
Advance payments for services are normally taxable in the year you receive the cash.
Okay.
And that's true even for businesses using the accrual basis, tracking income when it's earned, not just when cash arrives.
Right.
However, there's a key nuance here. An accrual basis taxpayer can elect to defer a portion of that income, but only to the following year.
Just 1 year.
1 year out. And what's interesting is this deferral works regardless of how long the services contract is for. But, the deferral can't go beyond that next tax year.
Correct.
And really important, this doesn't apply to things like prepaid rent or interest or insurance premiums. Those are always fully taxable in the year you get the money.
Right.
No deferral allowed there.
Gotcha. Always taxable upfront for rent and interest. Okay. Now, this next point, I think this trips up a lot of people, even experienced owners. It's the difference between what we casually call passive income and what the tax code defines as passive activity income.
Yes, this is a huge aha moment. They sound almost identical,
They do.
but they are definitely not the same thing in the eyes of the IRS. The tax code basically sorts income into three main buckets.
Yeah.
You've got active income, passive activity income, and then portfolio income.
Okay.
Now, many things we commonly think of as passive income, like interest from a savings account or stock dividends, those actually fall under portfolio income.
Okay. Not passive activity.
Exactly. And portfolio income items are explicitly excluded by definition from being treated as passive activities. Now, why does this distinction matter so much?
Yeah, why?
Because passive activity losses from these specific types of activities generally cannot be used to offset your active business income or your portfolio income.
Oh, wow.
Yeah, there are very few exceptions. So if you have losses from a passive activity, they might get suspended. You can't use them to lower your tax bill on your other income that year. it can be a nasty surprise.
So let me see if I've got this. Passive activity income is specifically revenue from a business where you, the taxpayer, you don't materially participate. Like you put money in, but you're not involved day to day.
Precisely. That's the core idea. It includes things like being a limited partner in a business venture where you're just an investor.
Okay.
And crucially, it also generally includes rental real estate activities, even if you are actively involved, like managing your own rental property.
Oh, really? Even then?
Even then, unless you qualify as a bona fide real estate professional. That's the big exception for rentals.
Okay, and being a real estate professional for tax purposes sounds like a high bar. Well, what does that actually take?
It is a significant hurdle. You have to meet two very specific tests. First, more than half of all the personal services you perform during the year have to be in real property trades or businesses where you materially participate.
More than half your work time.
Right. And second, you have to perform more than 750 hours of service during that tax year in those real property trades.
750 hours, okay.
If you hit both those marks and you materially participate in each separate rental activity, then any losses from those rentals are not passive, which means they could be deducted in full against your other income. And there's another big benefit too.
Oh, yeah.
You generally avoid the 3.8% net investment income tax on that rental income if you qualify as a real estate professional. That could be a substantial saving.
Wow. So, better loss treatment and potentially avoiding that extra tax. That's a really powerful incentive for serious real estate investors to meet those tests.
Absolutely. It really highlights how your level of involvement, your participation directly shapes the tax outcome.
Yeah.
We also see this with businesses like hotels, motels, B&Bs,
Right.
or anywhere you provide what the IRS calls substantial services like daily need service. Their income isn't treated like typical passive rental income on Schedule E. It goes on Schedule C, like an active trade or business, and it's subject to self-employment tax. The nature of the activity matters.
So the definition of rental activity itself is key.
Okay.
Let's also touch briefly on grouping activities. I imagine businesses might want to lump things together to try and meet those material participation thresholds you mentioned.
They often do, yeah.
Yeah.
There's something called a Section 469 grouping election. It lets you treat multiple business or rental activities as a single combined activity specifically for the passive loss rules. The main reason to do it is exactly what you said, to help meet those material participation tests for the combined group, potentially turning passive losses into active deductible ones.
But it sounds like there might be a catch.
There is. It's a big decision because this election is irrevocable. Once you group them, you're generally stuck with it.
Ah.
And it affects how suspended losses are treated down the road. If you have suspended losses from that group, they aren't released, they don't become deductible until you dispose of the entire grouping of activities, not just one piece of it. That could be years later.
Ooh, okay. So irreversible and potentially traps losses. Good heads up. Finally, before we switch to expenses, what about unexpected income, like court awards or settlements? Are those always taxed?
Not always. There's a key distinction. If the payment is compensation specifically for physical injuries or physical sickness, it's generally excluded from your taxable income.
Okay, physical injury is key.
Yes. But most other types of awards or settlements are taxable income. Think damages for patent infringement, breach of contract, lost profits, and any interest paid on an award is also taxable. Here's a critical point, though. Punitive damages.
Punitive damages.
Those are always taxable as ordinary income. Doesn't matter what the underlying claim was about physical injury or not. If it's labeled punitive, it's taxed.
Got it.
Although, interestingly, they aren't subject to self-employment tax, just ordinary income tax. So knowing exactly what the settlement payment is for is crucial.
Definitely. Okay, let's flip the coin now. Let's talk about the other side, business expenses. Reducing taxable income is huge, right? But there are rules and probably some surprises about what actually counts as a deductible expense.
Indeed. The fundamental rule is that to be deductible, an expense must be both ordinary and necessary.
Ordinary and necessary. Okay, what does that mean practically?
Well, ordinary basically means it's common and accepted in your particular trade or business. It's something others in your field would typically incur.
Okay.
Necessary means it's helpful and appropriate for your business. It doesn't have to be absolutely indispensable, just helpful.
Helpful and appropriate.
Yeah.
Got it.
And of course, underlying all this is the business must genuinely have a profit motive. You can't just deduct expenses for a hobby that consistently loses money.
Right, no hobby loss deductions. Okay, so thinking about Alex's graphic design agency again, getting it off the ground. What about those initial costs before she even lands her first client? Startup costs, organizational costs.
Yeah, there's a helpful rule for that. Businesses can actually deduct up to $5,000 of organizational costs and another $5,000 of startup costs immediately, right in the year the business officially begins operations.
Okay, 10,000 total potentially.
Potentially, yes. $5K for each category. Now, there's a catch. This immediate deduction starts to phase out dollar for dollar if your total costs in either category exceed $50,000.
Ah, okay, so it's aimed at smaller startups mainly.
Primarily, yes. Any costs above that initial $5,000 deduction or costs incurred if you're over the $50 threshold have to be amortized. That means spread out and deducted over 180 months, 15 years.
15 years, wow. Okay, and what counts as startup versus organizational?
Good question. Startup costs are things like market research, analyzing potential locations, pre-opening advertising, employee training before you open. Organizational costs are more about forming the legal entity itself, like state filing fees, legal fees for drafting partnership agreements, or articles of incorporation.
Got it. What if the business idea just doesn't work out? Alex does all this research, spends money, but decides not to launch. Are those costs just lost?
This is an important distinction, and it depends on who incurred the costs. For an individual taxpayer, if they make a real bona fide attempt to start or buy a specific business and it fails before starting, those costs are treated as capital costs.
Yep.
They can then be claimed as a capital loss. But that's subject to the annual limit, typically $3,000 per year against ordinary income after offsetting any capital gains.
Right, so you might recover it slowly.
Exactly. However, for a corporation, the rules are actually more favorable. If a corporation investigates starting or acquiring a business and it doesn't pan out, they can generally deduct all those investigatory costs as a business loss the year the attempt is abandoned.
Oh, that is a big difference. A corporation gets a full deduction right away.
Yeah, it's a significant planning point depending on the entity structure.
Definitely. Okay, shifting to everyday operations. Lots of self-employed people work from home now. The home office deduction, how does that work and what are the pitfalls?
It's definitely a common deduction, but also commonly misunderstood. The absolute key is the space must be used regularly and exclusively for your business.
Regularly and exclusively, both.
Both. Regularly means ongoing use, not just occasional. Exclusively means only for business.
Yeah.
That corner of the dining room table usually doesn't cut it if the family eats there too. The space also generally needs to be your principal place of business, or a place where you physically meet with clients or customers on a regular basis. Or it could be a separate unattached structure, like a detached garage converted into an office.
Okay. And how do you calculate it?
You basically have two main options. There's a traditional or actual expense method. You figure out the percentage of your home used for business, say 10% of the square footage, and deduct that percentage of your actual home expenses, mortgage interest, property taxes, utilities, insurance, repairs, depreciation.
Sounds complicated.
Can be, yeah. Requires good record keeping. The alternative is the simplified method. Much easier.
Okay.
With the simplified method, you just take a standard deduction of $5 per square foot of your dedicated home office space up to a maximum of 300 square feet.
So max $1,500 deduction. 5 by $300 SEC-UFT.
Exactly. Maximum $1,500. The big advantage, besides simplicity, is that even using the simplified method, you can still deduct your full mortgage interest and real estate taxes on your personal Schedule A if you itemize. You don't have to allocate them like with the actual expense method.
Ah, that's a nice bonus. Okay. What about meals and entertainment? I feel like these rules change all the time, especially after the TCJA, the Tax Cuts and Jobs Act.
They definitely did change significantly. The biggest headline is that most entertainment expenses are no longer deductible, period.
No more client golf games or concert tickets?
Generally, no deduction for those anymore, sorry golfers. But there are important exceptions.
Okay, like what?
Well, for instance, if your business provides entertainment to the general public, think a nightclub hiring a band, that cost is still 100% deductible. It's part of their business operation.
Makes sense.
Also, company-wide social events, things like the annual holiday party, summer picnics, team building events. As long as they're primarily for the benefit of your regular employees, not just the owners or top execs, those are typically 100% deductible. That includes both the food and the entertainment.
Okay, good news for holiday parties. What about just regular business meals? Like Alex takes a client out for lunch to discuss a new project.
Those common business meals are generally 50% deductible.
50%. Okay.
This applies when you're traveling for business, taking clients or prospects out, meals during business conventions, that sort of thing.
Hmm.
The key is it has to have a clear business purpose, and you or an employee has to be present. You can't just deduct buying your own lunch.
Right. Needs a business connection.
Exactly. And an interesting detail, if you have food and beverages provided during what would otherwise be non-deductible entertainment, say,
Hmm?
catering in a suite at a baseball game, you could deduct 50% of the food and beverage cost if it's stated separately on the bill or invoice.
Ah, so get separate invoices. Good tip.
Always helps.
Speaking of clients, what about sending gifts? Like a thank you basket. Can you deduct business gift?
You can, but the rule here is quite strict. There's a limit of $25 per person per year.
Only $25. That's not much.
It hasn't been updated in decades, unfortunately. That $25 limit doesn't include incidental costs like gift wrapping, packaging, or mailing, though.
Okay.
And there's an exception for small promotional items,
Mm-hmm.
things like pens, keychains, cheap stuff with your business name clearly and permanently imprinted that cost $4 or less each.
Hmm.
Those don't count towards the $25 limit.
Hmm.
Same for display racks you might provide to a retailer.
So branded swag is different from a gift basket. Got it. Any final thoughts on expenses that are just flat out not deductible, things people might try to claim?
Yeah, definitely a few big ones to remember. Political contributions are never deductible as a business expense. Same for lobbying expenses aimed at influencing legislation.
Okay.
Dues paid to country clubs, golf clubs, athletic clubs.
Mm-hmm.
Even if you do business networking there, the dues themselves aren't deductible. Yeah. Penalties and fines paid to any government agency, not deductible. Think traffic tickets, safety violations, late tax payment penalties.
Yep.
And finally, legal or other professional fees related to purely personal matters. Those can't be mixed in as business expenses. Keep business and personal separate.
Absolutely critical. Okay, let's pivot again. Let's talk about assets, the big ticket items. Buildings, equipment, vehicles, how businesses recover the costs, and what happens when they sell or swap them. Strategic timing seems really key here.
It absolutely is. This is where understanding depreciation comes into play. Depreciation, fundamentally, is an income tax deduction. It lets business recover the cost of certain property over its useful life, accounting for wear and tear, usage, or becoming obsolete.
Right, spreading the cost out.
Exactly. Most tangible property you use in your business is depreciable buildings, machinery, equipment, vehicles, furniture. But, and this is crucial, land itself cannot be depreciated.
Land doesn't wear out, I guess.
That's the thinking. But improvements on the land, things like fences, roads you build on your property, paved parking lots, landscaping, those can be depreciated.
Okay, so how do businesses usually figure out the depreciation amount each year? Is there a standard way?
Yes, the most common method by far is the Modified Accelerated Cost Recovery System, usually just called MACRS.
MACRS, okay.
Under MACRS, different types of assets are assigned to specific property classes, and each class has a set recovery period, like how many years you depreciated over. For example, computers and light vehicles are often in a 5-year class. Office furniture, fixtures, machinery often fall into a 7-year class.
So it's faster early on, accelerated.
Generally, yes. For personal property like equipment, it uses methods that give you bigger deductions in the earlier years. Real property, though, buildings, is different. It uses the straight line method, meaning the cost is deducted in equal amounts each year over a much longer life. For a non-residential real property like an office building or warehouse, it's 39 years. For residential rental property like an apartment building, it's 27.5 years.
Wow, 39 years, that's a long time. Okay, now for something really interesting, especially for businesses making big purchases, Section 179 versus bonus depreciation. They both sound like ways to write off assets faster, maybe even immediately. What's the difference?
They are both incredibly powerful tools for accelerating deductions, getting that tax benefit up front. But they work quite differently, and choosing the right one depends on your situation.
Okay, break it down. Section 179 first.
All right. Section 179 lets a business elect to expense, meaning fully deduct, the cost of qualifying property in the first year it's placed in service. This applies to new and used tangible personal property, like machinery or equipment, and also certain qualified real property improvements.
Fully deduct the whole cost.
Up to a limit, yes. For 2024, the maximum amount you can expense under Section 179 is $1,220,000. There's also a limit on the total amount of equipment purchased before the deduction starts phasing out.
Okay.
But here's a critical strategic difference from bonus depreciation. The Section 179 deduction cannot be used to create or increase a business loss. It's limited to your taxable business income for the year.
Ah, so if you're already having a loss year, 179 might not help much.
Exactly. You also get to choose which specific assets you apply the Section 179 deduction to, which gives you some targeting ability.
Okay. So how does bonus depreciation compare them?
Bonus depreciation is different in several key ways. First, it's generally automatic for qualified property unless you specifically elect out of taking it.
Automatic, so you don't have to choose.
Right. It applies by default.
Yeah.
Second, and this is a huge difference from Section 179, bonus depreciation can be used to create or increase a net operating loss.
Oh. So even if you're losing money, bonus can still give you a bigger loss to carry forward or back.
Correct. That's a major advantage for some businesses, especially capital-intensive ones or startups. Third, there's generally no annual dollar limitation like with Section 179 and no overall investment limit.
Wow. Sounds almost too good to be true. Is there a catch with bonus?
The main catch right now is that under the TCJA, the bonus depreciation percentage is phasing down. It was 100% for a while, but for property placed in service in 2024, it's down to 60%. It drops to 40% in 2025, 20% in 2026, and then it's scheduled to be 0% starting in 2027, unless Congress changes the law.
Ah, so it's phasing out. That's critical info for planning.
Absolutely.
Yeah.
Also, if you do choose to elect out of bonus depreciation, that election generally applies to all property within a specific asset class placed in service that year. You can't pick and choose individual assets like you can with Section 179.
Okay, so Section 179 lets you pick assets but is limited by income. Bonus is automatic, can create a loss, but is phasing down, and election out is all or nothing per class. Got it. Understanding those is vital for big purchases.
Definitely impacts cash flow and tax planning significantly.
So what happens down the road when a business gets rid of an asset? Sells it, trades it, scraps it?
Right. Disposing of business assets needs careful handling, usually reported on Form 4797. One area that can cause unexpected problems is related party dispositions.
Related parties, like selling between family members or businesses owned by the same people.
Exactly. If you sell depreciable property at a loss to a related party, could be a spouse, sibling, parent, child, or a corporation you control, that loss is generally disallowed. You cannot deduct it.
Even if it was a totally fair market price, a real sale.
Even then, the relationship itself taints the loss deduction. Gains between related parties are usually still taxable, but losses are disallowed. It's a trap to be aware of, especially in family businesses.
Wow, okay. Good heads up. What about the flip side? Are there favorable rules when selling business assets?
Yes, there's a very beneficial category called Section 1231 property. This generally includes your depreciable business property, like equipment or buildings, and land used in the business, provided you've held it for more than 1 year.
Okay, held over a year. What's special about 1231 property?
It gets potentially the best of both worlds,
Okay.
tax-wise. If you sell Section 1231 property and your net result from all such sales in a year is a loss, it's treated as an ordinary loss.
Fully deductible against other income.
Exactly. Fully deductible. But if your net result from all Section 1231 sales for the year is a gain, it's generally treated as a long-term capital gain.
Which gets taxed at lower rates, right?
Usually, yes. Lower rates than ordinary income.
Yeah.
So losses are ordinary, good,
Mhm.
and gains are capital, also good. It's a very taxpayer-friendly rule for long-term business assets.
That is a great deal. Okay, and let's circle back quickly to those like-kind exchanges, the Section 1031 exchanges for real estate. You mentioned strict deadlines. How strict are we talking?
Extremely strict. Once you transfer your old property, the relinquished property, you have only 45 days to formally identify, in writing, the potential replacement properties you might acquire.
Just 45 days to identify. Wow.
Yes. And then you must actually receive the replacement property by the earlier of 2 dates, either 180 days after you transferred your old property or the due date, including extensions, of your tax return for the year you made the transfer.
180 days total, but potentially less if your tax deadline comes first.
Precisely. And these deadlines are ironclad. There's almost no wiggle room, except sometimes in cases of federally declared disasters. Miss a deadline by even 1 day, and the whole deferred gain usually becomes taxable immediately.
Ouch. Okay, so meticulous planning is essential for a 1031, but it sounds incredibly valuable for real estate investors wanting to keep growing their portfolio without immediate tax hits.
It absolutely is. It's a cornerstone strategy in real estate investment. Just quickly, there's a related but slightly different provision, Section 1033, involuntary conversions.
Involuntary, like if property is destroyed or condemned?
Exactly. Damaged in a fire or flood, destroyed, stolen, or taken by the government through eminent domain. Section 133 also allows you to defer gain if you reinvest the insurance proceeds or condemnation award into similar replacement property.
Okay.
The key differences here are the replacement periods are generally much longer, usually 2 years, sometimes 3 or even 4 for certain situations, like presidentially declared disasters or condemnations of business real estate. And you generally don't need a qualified intermediary like you often do in a 1031 exchange, making it a bit less complex administratively during what's already a tough time.
Good to know there's some flexibility when things happen to you rather than by choice. Okay, shifting gears one last time. Beyond the assets and income expenses on the balance sheet, managing employees, that brings a whole other layer of tax considerations, right? And big picture responsibilities too.
Absolutely. This isn't just about payroll tax. It's about compensation structure, benefits, reimbursements, and major compliance, like healthcare.
So let's start with compensation. Wages are pretty straightforward, but what if an employer gives property as compensation? Like maybe Alex gives a top designer a company car to keep.
Right. If an employer transfers property, like a vehicle or even company stock, as payment for services, the fair market value of that property, when it's transferred and no longer subject to substantial risk of forfeiture, is generally taxable compensation to the employee at that time.
Taxable income to the employee. Okay.
And the employer also usually recognizes a gain or loss on that transfer, as if they had sold the property for its fair market value. So there are implications on both sides.
Got it. What about reimbursing employees for expenses they incur, like travel or supplies? I've heard terms like accountable and non-accountable plans. What's the difference?
This is a really key distinction. Impacts both the employer's deduction and the employee's taxes. Under an accountable plan, the reimbursements are deductible by the employer, but they are not taxable income to the employee. No payroll tax is withheld. It's treated as the company paying its own expense.
Okay. That sounds like the ideal way.
It generally is. But to qualify as accountable, the plan has to meet strict IRS requirements. The expenses must have a business connection, the employee must adequately account for them to the employer, substantiate amount, time, place, business purpose, think expense reports with receipts, and the employee must return any excess reimbursement within a reasonable time.
Okay, lots of rules. What if it doesn't meet those rules?
If it fails any of those tests, it becomes a non-accountable plan. And under a non-accountable plan, any reimbursements paid are simply treated as additional taxable wages to the employee.
Oh.
So they're included in the employee's W-2 income, subject to income tax withholding, Social Security, Medicare taxes, the whole 9 yards. The employer still gets a deduction, but it's essentially just higher wage costs, and the employee pays tax on it.
So setting up a proper accountable plan is definitely the way to go for things like travel reimbursement.
This for sure saves the employee taxes.
What about other common employee perks, like health benefits or helping with education costs? Are there tax advantages there?
Yes, many fringe benefits offer valuable tax breaks. For example, group term life insurance. An employer can provide life insurance coverage, and the cost for the first $50,000 of coverage is generally excluded from the employee's income.
Okay, $50 K tax-free.
Right. Then there's educational assistance. If the education is job-related, the employer's payment can often be excluded as a non-taxable working condition fringe benefit. Even if it's not job-related, under a formal written plan, an employer can provide up to $5,250 per employee per year in tax-free educational assistance for tuition, fees, books, etc.
$5,250 tax-free. Nice.
And here's something really relevant right now. The CARE Act temporarily expanded that definition of educational assistance. Through the end of 2025, employers can also make payments towards an employee's existing student loan debt under this $5,250 annual exclusion.
Wait, employers can pay student loans tax-free up to that limit?
Yes. Payments made by the employer directly to the lender or employee for principal or interest on qualified student loans can be excluded from the employee's income, up to that combined $5,250 cap per year for all educational assistance. That's a huge potential benefit for attracting and retaining employees carrying student debt.
That is massive. Okay. What about health savings accounts, HSAs, and flexible spending accounts, FSAs? People often mix those up.
They do sound similar, but they're quite different beasts. A health savings account, HSA, is paired with a high-deductible health insurance plan. The key features are: it's owned by the employee, the funds roll over year after year if unused, they're immediately vested, and the account is portable. It goes with the employee if they change jobs. Contributions are pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. Triple tax advantage.
Employee-owned, portable, rolls over. Okay. And FSAs.
A flexible spending account, FSA, usually for healthcare or dependent care, is different. It's typically funded through pre-tax employee contributions, but it's an employer-sponsored plan. The big drawback is the use it or lose it rule.
Ah, the year-end scramble.
Exactly. Funds generally have to be spent within the plan year. Employers can offer either a limited carryover amount, around $640 for 2024, or a grace period of up to 2.5 months into the next year to incur expenses, but not both. And FSAs are generally not portable if you leave the job. HSAs offer much more flexibility and long-term savings potential.
Okay, HSA seems like the clear winner if you have the right insurance plan. Let's touch on something bigger picture now, the Affordable Care Act, ACA. What's the main thing employers need to know?
The big requirement is the employer shared responsibility provision, sometimes called the employer mandate. This applies if you are an applicable large employer, or ALE.
ALE, how do you know if you're an ALE?
An ALE is generally an employer who had, on average, 50 or more full-time employees, including full-time equivalents, FTEs, during the preceding calendar year. A full-time employee is defined under the ACA as someone working 30 or more hours per week, on average.
50 or more FTEs working 30-plus hours.
Okay.
If you are an ALE, what do you have to do?
If you're an ALE, you must offer minimum essential coverage, MEC, that is also affordable and provides minimum value to substantially all, generally 95%, of your full-time employees and their dependents up to age 26.
Offer coverage or
face potential penalties from the IRS. These penalties can be quite significant. It's complex. But the bottom line is large employers generally need to offer qualifying health coverage. Offering good benefits is also critical for attracting and retaining talent, so it serves a dual purpose beyond just compliance.
Right. But what if an employee just doesn't want the coverage? Maybe they're on a spouse's plan.
That's fine. There's no penalty on the employer if a full-time employee declines an offer of coverage that meets the affordability and minimum value standards. The penalty applies if qualifying coverage isn't offered in the first place, or if the coverage offered doesn't meet the standards.
Got it. Offer is key. Okay, finally, let's talk about tax credits. These are great because they reduce your tax bill dollar for dollar, right? And not just a deduction. What are some valuable business credits employers should know about?
Absolutely. Credits are powerful. There are quite a few, but some standouts include the Work Opportunity Tax Credit, WOTC. This provides credits for hiring individuals from certain targeted groups who have historically faced significant barriers to employment, like qualified veterans, ex-felons, or food stamp recipients. It's been extended through 2025.
Okay, WOTC for hiring specific groups.
Right. Then there's the Disabled Access Credit. This helps eligible small businesses cover costs associated with providing access for individuals with disabilities, complying with the Americans with Disabilities Act, ADA. Think ramps, accessible restrooms, adaptive equipment. It's up to a $5,000 credit per year.
Helping small businesses be accessible. Good.
For the restaurant and bar industry, there's the FICA Tip Tax Credit. This allows employers to claim a credit for the employer's share of FICA taxes, Social Security and Medicare, paid on employee tips that exceed the federal minimum wage. It helps offset that payroll tax cost on tips.
Okay, specific to tipped employees.
And one more really important one, especially for smaller employers, the credit for small employer health insurance premiums. This credit is specifically designed to help small businesses afford the cost of providing health insurance to their employees.
How small is small here?
Generally, fewer than 25 full-time equivalent employees paying average annual wages below a certain threshold, around $62K for 2024, and you have to pay a uniform percentage, at least 50%, of the premium cost for employee-only coverage offered through the Small Business Health Options Program, SHOP Marketplace.
Okay, specific requirements. What's special about this credit?
It's refundable, meaning even if the credit is more than the tax you owe, you could potentially get the difference back as a refund. It's a direct incentive from the government to encourage small businesses to offer health coverage.
Refundable. Wow, that's huge for a small business. Okay. Wow, we have really covered a lot of ground today, from, how income gets treated differently to planning expenses strategically, managing assets smartly with depreciation and exchanges, and then all those crucial employer responsibilities and credits.
We really have.
It's definitely clear that the world of business taxation, it's not just following rules, is it? It's incredibly nuanced, but full of opportunities too.
Indeed. I think what really stands out from digging into this is that the tax code, yeah, it's complex, no doubt about it, but it's also packed with these mechanisms for deferral, for specific deductions, for really powerful credits.
Right.
And when you understand them and you apply them strategically, they stop being just compliance headaches. They actually become tools. Tools that can significantly shape a business's financial health, its cash flow, its whole trajectory.
So what does this all mean for you listening in and navigating this world? I think it really shows that digging into these details, it's not just about avoiding trouble with the IRS or filling out forms correctly.
No, not at all.
It's about unlocking strategic advantages, making your money work harder for you, and ultimately building a stronger, more resilient business.
Which really raises an important question, I think, for you to ponder after this. Thinking about your own business or maybe the business you're planning,
Hmm.
what aspect of your financial situation might benefit the most from a deeper dive into some of these nuanced tax strategies we talked about?
Hmm.
Are there specific areas, income structuring, expense deductions, asset purchases, employee benefits where you might be leaving money on the table or missing an opportunity without even realizing it?
That's a great question to chew on. We really hope this deep dive has given you some powerful insights, maybe sparked some ideas, and definitely encouraged your curiosity to explore further.
Keep digging.
Exactly. Until next time, keep learning and keep asking those big questions.